Hello there, ExxonMobil employees, and welcome. Thank you so much for joining us today. I'm Sam, and I moderate these weekly presentations. And in just a second, we're going to be joined by Wesley Boudreau, who's going to be giving you an update on interest rates and how they'll affect your pension from ExxonMobil when you decide to retire. Afterward, Wesley should have time to answer one or two questions. I apologize in advance if he does not answer all questions throughout the presentation. Please feel free to still ask away. It's completely anonymous, and we will make sure that someone will reach out to you after the presentation to answer those questions for you, either through phone or email. I should also remind you very quickly, we are not affiliated nor endorsed whatsoever by ExxonMobil. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along. Lastly, throughout Wesley's presentation, you are going to see me enter some links. They're going to pop up on your screen as you watch this presentation. You can click on those. They're going to guide you to various resources, one of which is our calendar, where you can book an appointment with either Wesley himself or one of his colleagues to speak to them directly about your specific concerns or situation. And also, please follow us on YouTube and LinkedIn. We post tons of Exxon-related retirement-focused content weekly, and we really think you would get some value out of it if you decided to follow us. And if you do, thank you in advance. And without further ado, we'll jump right into it with Wesley Boudreau.
All right, thank you very much for that introduction, Samantha. And like she said, today we're going to be talking about the ExxonMobil pension plan. We'll give a kind of a comparison of the lump sum versus the annuity. I apologize about the bland background. I'm traveling this week, but we'll get through this. And we did I did a seminar or webinar about maybe a month and a half or two ago, kind of a similar topic, but going into the interest rates, how we had them updated for the first quarter of 2025, and provided some actual examples of some different calculations. So that's definitely one to look at as well. I'll be sure to make sure we provide that link at the end of this webinar as well. Now, even though myself and a lot of other retirement group advisors work specifically with ExxonMobil, it does not mean that we're endorsed or employed by Exxon, but we'll definitely dig through this, kind of give you some more expertise and help you out with what your options are going forward. So a quick basic review, we're going to dig into what the ExxonMobil defined benefit plan is. That's the pension plan, what your different choices and options are in there. I will also go into the lump sum, give you kind of a quick example, kind of like a mortgage, to give you an idea of how those interest rates can actually affect it. And we'll also talk about the interest rates they use and what that look back means and how it affects you specifically versus other companies. But a quick refresher as to the ExxonMobil pension plan. Again, it is a defined benefit plan. There's a formula that's used in order to calculate out your single life annuity, and then all other forms are calculated off of that. So if we see on this chart here, we've got your single life annuity option, and it's going to be, you have the option of adding a joint and survivor annuity we'll talk about. Period certain, that's if you want to make sure that, God forbid, something happens to you sooner rather than later. It's going to be provided, there's an automatic 5% period certain, but you can add a 10, 15, or 20. So what that means is if you pass away before one of those time periods, that's still going to get paid out to your beneficiaries. And then you can actually take that annuity value and do a joint survivor with your spouse or significant other. And you can also turn it into a lump sum. We'll talk about interest rates, how those affect the lump sum there as well. And there's a myriad of combinations you can do. Exxon was one of the few companies that gives you the choice of kind of breaking it down to 25% intervals, where you can do both a lump sum and a annuity. So not many choices, not many other firms out there have those options. And then as far as normal retirement age, one thing I need to make sure you remember, we go into this in more detail and give you the age bands on the other webinar, but you need to try and make it to 55 plus 15. So that means 55 years old and at least 15 years of service. That constitutes you as a retiree and not a terminee. So retirees got more benefits as far as the ability to take the lump sum and a better calculation method as far as what percentage of the pension you get there as well. As a terminee, does not have the lump sum option. However, we have seen in recent years it has been offered, but normally speaking, it's not offered. And your discount factor as far as what percentage of your pension you're going to get is a lot more severe. Again, we go through that on other webinars where you can give me a call. I'll be happy to go through it with you as well. So let's talk about the different options. So again, single life annuity. That's essentially what this pension plan is based off of. It's a classic defined benefit plan, in which case there's a formula that's used to calculate out what your single life annuity is going to be. They look at your years of service times your final average pay times 1.6% multiplier. Then they back out Social Security offset times a 1.5% multiplier to actually figure out, okay, how much am I going to pay this person over the rest of their life? So let's say they run a calculation, it comes out to $3,000 a month for the rest of your life. So that's your single life annuity that you're going to get paid. as long as you live, whether that's 7 years or 25 years or 40 years. And then from there, that's where you have the other options. Now, again, that's a single life annuity. It's fixed, does not grow with inflation, so you have to be aware of that. Obviously, we've seen the last couple of years, inflation reared its ugly head and things get more expensive, so you have to be a little bit kind of concerned and focus on that. So if you get that $3,000 a month now, it's not going to buy the same thing in 10, 15, 20 years as well. So that's why it's important to run a financial plan, which we'll talk about later as well, where you can put these together and kind of show you what it looks like, your choices, not just now, but how they play out in 10, 15, 20, 30, even 40 years, and how they affect your beneficiaries as well. Now, as far as if you decide that you want to, that you're married and you have a significant other, and you want to make sure that he or she is taken care of as well, that's where you add a joint survivor. The joint survivor is going to actually pay you less. So if I go back to that example of $3,000 a month for somebody, if it were myself and I were making sure my spouse was covered, she's about a year younger than I am. So what's going to happen is Exxon's on the hook for paying out over the course of 2 lives. So the likelihood of them paying out longer goes up. So that means they're not going to pay quite as much. So instead of maybe getting $3,000 a month for the rest of our lives, it may be that maybe I get $2,600, and if I were to pass away, if I did a 50% joint survivor, she will get $1,300. Or maybe if we did a 100% continuation, maybe I only get $2,500 a month for the rest of either one of our lives. So because it's a 100% continuation. And then Exxon gives you the ability to break that down 25% intervals. So 100% continuation, 75, 25, 50, 25, and I think they even give you a 1%, which is kind of a slap in the face. I don't know anybody that's ever done that to their significant other. And on top of this, we've also got the where Exxon's also got the period certain I mentioned before. So they automatically give you a 5-year period certain. So if something happens to you in the first 5 years, it's going to still get paid out. But if you want to add a 10, 15, or 20-year period certain, you can do that to both the single life annuity and the joint survivor annuity option as well. The other one that we see a lot of people definitely were taking the last couple of years was a lump sum, but once interest rates started going up, that did affect those lump sums. So we're starting to see more people potentially review the option of taking the annuity versus the lump sum. And that's something we do day in and day out. And we're always going to review those options. Even if you come to us saying, hey, Wesley, I want to take my money and run, I want to get that lump sum, we're still going to say, okay, well, let's look at the single life or joint survivor annuity options. Let's play those out in a cash flow analysis and see how it looks for you. And run those side by side, make sure that it is the prudent choice to take that lump sum and go through all the ins and outs, pros and cons, pitfalls, and things of that nature. Some of those just so you have an idea. The lump sum obviously is going to give you, or let me back up. What they're doing for that lump sum is they're saying, okay, I'll go back to that $3,000 example. They're going to say, okay, well, let's say this person's retiring at 60, life expectancy is 86, so we know we're going to have to pay them theoretically for 26 more years based upon actuarial tables. So they'll take those 26 years of payments and say, okay, well, what are the current interest rates? Let's factor that in and figure out what the net present value is that we need to give he or she in order for them to go out there and try and recreate that same $3,000 a month paycheck, essentially. So that's where you get that lump sum calculation in there. It is based upon those factors. There's nothing that you or I can change on there. The interest rates, however, do fluctuate, and we'll talk about those in a moment. And those are something that can dictate your lump sum going up or down. And I mentioned that before. We saw a lot of those going up and down. So it is important to look at those side by side. Some of the pros and cons, obviously you get full control of those assets. You're able to do what you want with them, whether you want to invest those or take them out, defer them, get your own annuity. We'll go over those options a little bit later. But it also comes with the risk of whether or not you spend those down too quickly or mismanage them. Unfortunately, I've seen the situations where somebody gets a big lump sum and all of a sudden the family comes out of the woodworks. They're starting to ask for help here and there, and it's hard to turn them down. Maybe you help too many people out and spend it down too quickly, or maybe you spend it down yourself too quickly. That's one key aspect, but again, it does also give you control, so you can look at managing inflationary pressures yourself versus that annuity. You're not going to have that option. And then as far as the kind of a comparison of how those interest rates work, I'll get onto the actual interest rates in a moment. But let's go through kind of a quick, simple example. Let's assume that you're looking at interest rates and how they affect your lump sum versus how they might affect a mortgage or buying a house. I think we all know that lower interest rates are good for home buyers because it means you can get a bigger mortgage or afford more. So in this example here, if we look at a mortgage on the a mortgage versus annuity payment on the left-hand side, let's assume that all you could afford was $1,950 to buy a house. When you're looking at your qualification, and that $1,950, if we had a 4% interest rate on there for a 30-year period loan, that's going to allow you to buy about a $408,000 house or finance about $408,000 towards that house beyond what your down payment is. Now, on the flip side, if interest rates were to go down to 3%, you can see actually now, hey, I can afford about a $460,000 loan. So that means I can afford a bigger house, or vice versa. If interest rates are high, I'm going to get a lower lump sum, maybe 400,000 in this case, versus if interest rates go down, it may go up to 460%. And we saw that happen during the pandemic as interest rates went down pretty darn low, the lowest we'll probably ever see them again. And so that raised a lot of lump sums. So we saw a lot of people take advantage of that at that point in time. Interest rates, in turn, that pendulum has swung. They've gone up higher. They kind of hopefully peaked out last year. So we saw some of the higher rates we've ever seen, which caused some of the lower lump sums. And then now we've seen those kind of come down, but they've kind of leveled off and bumped back up a bit. We'll talk about that in just a moment. So how are those interest rates used, and what does that actually mean? So what ExxonMobil uses is called the PPA segment rates. That's the Pension Protection Act segment rates. Used to be what are called the gap rates. So they still use that for grandfathered employees, those that are a little bit older, I think 67 or 68 years this year, and have a lot more years on a service. We can go through that in more detail if you qualify for that. But they go through and look at the PPA segment rates, and they're going to say, okay, well, based upon these interest rates, which are first, second, and third segment, we'll get to on the next slide, how are we actually going to calculate that out for this individual? And they do a look back. What they do is they look at the average of the final 2 months of the prior quarter. So we have a little bit of a crystal ball, if you would, as far as saying, okay, what are the interest rates going to be for this quarter versus next quarter? Should I take my lump sum now, or should I defer it? Should I retire sooner? Should I work longer? We can go through all those different options with you. But ExxonMobil is good because they do that quarter by quarter, give you a little bit of an advance notice, if you would. Some companies do it once a year, some do it every month. But Exxon's kind of there in the middle, where you get a little bit of a crystal ball in there to kind of find out what's happening there for you on the lump sum calculations. So getting into the actual lump sum calculations, I'm not going to pretend to see this without my glasses, so I'll zoom in here for you guys in just a moment. But you've got 3 columns here to be focused on. There's the first, second, and third segment. So what these are different age-based segments for the PPA segment rates. The first is going to cover years 1 through 5 of retirement. Second is going to be years 6 through 20, and the third, years 21 and beyond. So depending upon your age, you may or may not have more weight on that third segment. But for most of us, that second segment is going to have the highest weight because it covers 15 years of our retirement. So we tend to focus on that as far as having the biggest factor in here. Now, we look at that seesaw on the top here. That gives you, again, that correlation we talked about with the mortgage rates, where interest rates go up and down, it will change. So if interest rates go lower, it's going to raise your lump sum. If interest rates go higher, it's going to drop your lump sum. So again, in the pandemic, we saw interest rates go down, raising lump sums to the highest we've ever seen them. Post-pandemic, we saw interest rates kind of skyrocket, lower them to some lower lump sums. Now we've seen those interest rates over the last couple months, last half year or so, start to drop again finally. However, we saw them kind of, I'm not going to say bottom out, but they recently have bottomed out and gone back up in October, November. We'll talk about that in just a moment once I zoom in here. But again, what's going to happen is those interest rates they use, they look at the final 2 months of the prior year, the prior quarter. So based upon the interest rates for August and September, that's going to give us what the first quarter of 2025 is. We do not have December interest rates out yet. Once we get the interest rates for November and December, we will see and know what they are going to be for the second quarter. But so far, it doesn't look too good. So let's go ahead and zoom in here. So if we look at that first one in the blue or the bold, that's Q1 2025, the blended rate. So again, based upon the rates from August and September, we got 4.34%, 4.86%, and 5.33%. Those are going to be the rates for your PPA segment rates, and the grandfather is going to be 4%. And if we look at that top line, or actually if we go below there, you can kind of see how those interest rates were higher last year. That middle segment, we're looking at 4.86%, actually was higher at 5.35%, 5.21, 5.45, and 5.59. And we got to go all the way back to first quarter 2023 before we get to where those interest rates were back in the range that they are right now. So what that means is we've seen those interest rates come down, driving lump sums up. That change from one quarter to quarter, let me get that zoom back in. I apologize. That change from 5.35 to 4.86. That's close to. Sorry, let me pull it back up. The 4.86 to 5.35. So we got about 35, 40, it's about 50 basis points or so roughly in there. So that means your lump sum has probably gone up roughly about 5 percentage points, maybe 4 to 6 percentage points. So if you had $1 million lump sum for fourth quarter, it could be $1,040,000, $1,050,000 or so first quarter. But if we look at that top line there too, unfortunately, like I said, October, November, those interest rates started going the other direction, going up. So it's very likely we won't get December rates until the third week or so of January. but it's very likely those are going to be higher. So if you're looking at taking that lump sum and you've already retired and you were deferring, we got a couple of guys we're working with right now that were doing that, and they've decided, hey, we're going to take advantage of this lower interest rate this quarter and the first quarter of 2025, and we're going to go ahead and take that. And that would probably be our advice if you're leaning towards that lump sum. But again, we should review the annuity versus lump sum options. So again, a quick summary of what your choices are on the options here. Again, everything's derived from that single life annuity based upon that pension calculation. So you have the single life annuity as choice one. The period certain, you can add again a 10, 15, or 20-year period certain to make sure you're paid out. God forbid something happens to you sooner in life. Joint survivor annuity, if you want to make sure that your significant other is taken care of for his or her continuation as well. You can also combine that with the period certain. So those are all the annuity options. If you were to take the lump sum, then you've got multiple choices there as well. You can take that lump sum, take full control of it. You can go out and spend it all tomorrow if you really want to, but obviously you don't want to do that. But you can take that, you can invest it. If you're a DIY person, you can work on your own. Just be sure that you are aware of your risk tolerance and make sure you manage it appropriately and don't spend through it, because that's the key risk you have in that lump sum if you're doing things on your own. So you can invest it, withdraw, you can invest it and defer it. We got individuals that have left ExxonMobil and gone and contract or done something else or don't need that, so you can potentially defer that, let it grow until you do need it. You can actually annuitize all of it or a portion of it on your own if you want private annuitization. We can look at comparing interest rates outside of ExxonMobil, so that way you may be able to get a higher income level than what ExxonMobil provides you. You could also get some additional features like a cash refund. So if something were to happen to you, instead of getting paid out over that period certain, your beneficiaries get a lump sum cash refund. So we go through all those. Right now they're kind of neck and neck, but a year ago it was a situation where we were seeing individuals being able to get $500 to $1,000 a month more doing it this way versus their Exxon pension annuity. So just give us a call. We can run the rates and see where those stand right now. And then obviously you can combine all these different options because Exxon gives you some of that flexibility where you can do a lump sum and an annuity as well. So we'll be happy to go through all these with a financial plan with you. Sorry, went backwards. We'll be happy to go through all these with a financial plan with you so you can see where you stand. But right now, about 3/4 of Americans over 50 don't have a written plan. If you can spend about 10 minutes with us gathering some data, we can get that put together for you. Give us a couple of days to put it together. Then we'll sit down. We can review that over the phone or via email or web or in person, whatever your preference is, and kind of show you where you stand, let you know, hey, can I retire when I want to? Should I work longer? Can I go sooner if I want to? How should I take this pension? Should I take it as a lump sum or the annuity? We can run a number of different scenarios so you can see where you stand in that process. So again, we talked a lot about helping you out, but who the retirement group is, again, we are an independent financial advisory firm that focuses on working with corporate employees. We've worked extensively with ExxonMobil for a long time, myself included. So our advisors that work with ExxonMobil have a deep understanding of your pension plan, your 401k, your healthcare, retiree medical benefits, your life insurance continuation, things like that. So any question you have, give us a call. We'll be happy to help you out. We can probably get some of those questions answered for you pretty quickly, and we can walk you through how to model your pension through Light and help you look at your 401k through Voya as well and give you a full comprehensive review. We have offices throughout the country, so rest assured if you need to sit down with somebody face-to-face, we can likely accommodate you there. But again, we can do web meetings, phone calls, email, whatever your preference is. And like I said, that cash flow analysis, that financial plan, take us up on that. That's complimentary. Just in hopes that when it comes time that you do need help, you throw a hat in the ring when you talk to firms if you're not going to do things on your own. And again, if you've done one that's been a year or two, circle back to us because things have changed on interest rates and the market. So it's good to look at that as well. So with that, I'm going to kind of wrap this up. Leave the screen up here, give you some contact information. So you can email us at info@theretirementgroup.com. You can call us at 800-900-5867. There's a couple QR codes on here if you want to try and use your phone to schedule an appointment with myself or one of the other ExxonMobil focused advisors, or you can get into our LinkedIn page if you want to follow along with us there as well and see what other seminars and webinars we have coming up as well. And hopefully what we'll do is we'll use this screen because I'm going to have this on for the questions that's all come through. We'll leave this up and we'll throw a link into that other webinar I mentioned before. Again, we're going over the lump sum and annuity options here, but we did a different webinar a month or two ago that I also put in some examples of comparisons, and but the interest rates were the same there. So it's a good sister or brother to this webinar, I guess, if you want to piggyback and look at those as well. So let me go ahead and take care of these two questions that came through, and I'll let you guys go. So the first question was, when do I have to take my pension, and how much will I get? Okay, so I kind of alluded to this on the on when I talked about the terminee versus retiree and how much you get from there. So again, that other webinar I mentioned, it's got the chart in there. But as a retiree, essentially speaking, at age 60, that's where you get 100% of your pension. If you're to retire earlier, you can actually you can take your pension, but you can get a reduced amount. So at 55, it's going to be 5% reduction each year. So at 55, you only get 75%. Then so then 80, 85, excuse me, 80, 85, 90, 95%, then 100% at 60 again. So you can retire at 55 and just wait it out and defer and get a 5% raise each year. But if you're thinking about taking the lump sum, you got to also factor in whether the interest rates are changing and eroding that, or if it's growing. So we have to go through that. We're working with some people right now that are going through that same exact situation. So again, let's say if you retired at 56, you can take it, but you can get 80% of it. And so we can run those reviews and the different options you have there on it. And as far as having to take it, so you can retire and then commence your benefits later. So again, like I said, you can retire at 56 and defer that out to 60. There's no sense in deferring later than that because you're not going to get any increases. You're actually going to get a decrease because when you look at the factor of the lump sum, you're getting closer to your date of death. So you're going to start seeing that amount go down there a little bit. So again, keep that in mind. And then another question, kind of somewhat similar, I guess, is can I start and stop my annuity? So the answer to that's no. So if you were to decide to take the annuity on the pension, whether it be a joint survivor or a single life annuity, once you do that, you're stuck with that. So if I go back to that $3,000 example I gave you, if I were to go ahead and retire, set it up at $3,000 a month, and then let's say a year runs by and I get bored at home and I say I'm going back to work, and whether it's part-time or full-time or whatever, and I say, well, gosh, I don't need this $3,000 a month anymore. Now it's bumped me up in the next tax bracket. I don't want it. I can't go in there and stop it, unfortunately, with ExxonMobil. So that's something where, again, we talk about potentially private annuities. You can do some of those different options potentially, but that's also where it comes down to our conversation with that cash flow analysis and the financial plan to determine, okay, what does this retirement look like to you? Are you done? Are you going to sit at home for a little bit and then go back to work? And we kind of go through those different pros and cons and options, and we can play those out in the cash flow analysis to show you. So that's where somebody says, hey, look, no, I'm a busybody. There's no way I can sit at home. I'm going to do something. That's where we might say, well, you may want to look at least a portion of this as a lump sum versus all of it as an annuity. So you avoid getting into a situation like I just mentioned there. So again, any other questions anybody's got for us, just give me a call. You can reach that 800-900-5867 or that email we had up there as well. Again, I've worked extensively with ExxonMobil employees and some of our other advisors that our ExxonMobil focused advisors have. So we'll be happy to help you out. Again, it doesn't mean we're employed by Exxon, but again, our expertise can help you out with running through these scenarios and help you determine the best day to retire and help you run through those different options and pros and cons of the pension lump sum versus the annuity. So I want to thank everybody and I hope you have a great day.